What if I told you there's an exchange generating close to $1 billion in annualized revenue, with no company behind it, no central server, and no middleman taking your money? And what if I told you Wall Street is now racing to turn it into an ETF? This is Hyperliquid, and by the end of this video, you'll understand exactly why it might be the most important DeFi project of 2026. Hyperliquid is a fully on-chain perpetual futures exchange, built on its own dedicated Layer 1 blockchain. This isn't a DEX sitting on top of Ethereum or Solana. Hyperliquid built the entire infrastructure itself, optimized from the ground up for trading. The result? 200,000 orders per second, sub-second finality, and zero gas fees. Think of it as Binance Futures, but entirely on-chain, non-custodial and self-sovereign. You keep control of your funds at all times. No KYC, no withdrawal freezes, no exchange collapse risk. In November 2024, Hyperliquid did something almost unheard of in crypto. It airdropped its Hype token directly to over 90,000 early users. Zero VC allocation at launch. No early investor dump. Just a direct reward to the community. The token launched at around $3.20. Today, it's trading near $38. That's a 1,000% move, while generating real, verifiable revenue. Hype sits at a $9 billion market cap, ranked number 15 globally. The all-time high was $59.30, meaning it's still 35% off its peak right now. Here's where Hyperliquid stops being just a DEX and starts becoming an entire financial ecosystem. HyperEVM is Hyperliquid's Ethereum-compatible execution environment, built directly into the Layer 1. Developers can build full DeFi apps using familiar tools, and those apps inherit Hyperliquid's liquidity and order books automatically. Felix, the native lending platform, holds $401 million in TVL. Hyperlend holds $380 million. Total TVL across the chain? Over $6.2 billion. HIP-3, Hyperliquid's permissionless listing upgrade, lets anyone create a perpetual market for any asset. Not just crypto. We're talking oil, silver, equity indices, commodities, all tradable on-chain 24/7. When US-Iran tensions spiked in March 2026, traders flooded in. WTI crude oil perpetuals hit $1.77 billion in volume in a single 24-hour period. Oil perpetuals made up 18% of Hyperliquid's total trading volume that day, while traditional markets were closed. 97% of all protocol fees go into Hyperliquid's assistance fund, which buys Hype on the open market and burns it daily, every day, automatically, with no human intervention. On March 20th alone, Hyperliquid topped the 24-hour fee revenue charts, generating over $2 million in a single day. Weekly fees hit $14 million, a 56% jump week over week. Annualized, that's approaching a $1 billion revenue run rate. 37.5 million Hype tokens have already been permanently removed from supply through this mechanism. More volume leads to more fees, leads to more buybacks, leads to less supply. This is the flywheel, and it's spinning fast. On March 20th, 2026, Grayscale Investments formally filed a Form S-1 with the SEC for the Grayscale Hype ETF, proposed ticker GHYP, listed on Nasdaq. This joins similar filings from Bitwise and 21 Shares, three major firms racing to launch the first US-listed DeFi governance token ETF. This is the same type of catalyst that sent Bitcoin from $40,000 to $70,000 after its ETF approval. All right, let's talk strategy. Here is how informed participants are thinking about positioning in Hyperliquid, not as gambling, but as calculated game theory. Step 1. Understand your entry. Hype is currently around $38, approximately 35% below its all-time high of $59. The buyback mechanism provides a daily bid. The key support zone analysts are watching is $34 to $37. On April 6th, approximately 9.92 million Hype tokens, worth around $377 million, unlock for core contributors. Historically, unlocks create short-term selling pressure. This is a potential dip-buying window if platform metrics hold strong. According to Spotted Crypto Analysis, if weekly burns sustain above $8 million and TVL holds above $4 billion, the floor at $37 becomes increasingly credible. If you're a DeFi user, providing liquidity on Felix or Hyperlend earns real yield from genuine protocol activity, not inflationary token rewards. This is yield backed by trading fees. The SEC has approximately 240 days to review the grayscale filing. Any positive signal on the ETF front could serve as a price catalyst, similar to how Bitcoin ETF speculation alone moved BTC months before approval. Now let's be real, because no serious investor ignores the risks. About 238 million Hype tokens are allocated to core contributors, unlocking through 2027 to 2028. That's significant dilution. If the team starts selling, it could suppress price. The good news? According to CoinDesk, the team has so far chosen not to sell most of their monthly allocations. Watch their wallets. Total whale exposure on Hyperliquid hit $3.64 billion in March 2026, with a nearly 1-to-1 long-short split. This balanced leverage creates conditions for violent liquidations if a sharp market move triggers a cascade. Hyperliquid currently holds about 70% of perpetual DEX revenue, but competitors are watching. Lower fee challenges could erode that dominance if Hyperliquid doesn't keep innovating. The ETF filings are bullish, but Hype could face classification as a security. That would be a serious headwind. None of these risks make Hyperliquid a bad project. They make it a project that requires you to stay informed. Set your risk parameters before you enter, not after. Here's the bigger picture, and this is what gets lost in the price talk. Hyperliquid is proving something that the entire crypto industry has been trying to prove for a decade. That decentralized finance can match, and in some ways beat, centralized exchanges on performance, liquidity, and user experience. When a retail trader in Nigeria, or the Philippines, or Argentina can trade West Texas crude oil with a crypto wallet at 2 a.m. with no KYC, no broker, and no hidden fees, that's not just a product update. That's financial access being redefined. The fees are real, the volume is real, the ecosystem is real. And now, institutional capital is trying to find its way in. Whether Hype hits $150 or pulls back first, Hyperliquid, the protocol is already building the infrastructure of on-chain finance. Hyperliquid is not a promise. It's a protocol that's already generating revenue, already burning tokens, already building its ecosystem. And now, Wall Street is filing paperwork to get exposure to it. Whether you're a DeFi user looking to earn real yield, a trader watching the April unlock setup, or an investor building a long-term position, Hyperliquid deserves a serious look in your research stack. Do your own deep dive. Start at hyperliquid.xyz. Track the TVL at DeFi Llama. Follow the weekly fee data. Watch the team wallet activity and understand your risk before you touch it. If this video opened your eyes to something new, hit that like button, subscribe for the next deep dive, and drop a comment below. What's your biggest takeaway from Hyperliquid? I read every single one. Disclaimer: this is not financial advice. Cryptocurrency is an extremely high-risk asset class. You can lose everything. This video is for educational purposes only. Always do your own research. Never invest more than you can afford to lose completely. Do door. See you in the next one.